If you're looking to purchase an investment, whether that be property, shares, crypto, or something else, you need to understand what type of tax structure you're going to put these investments in. You have four main options to choose from. You can either put them in your own name, in joint names, in a trust, or in a company. Today, I'm going to go through all four of these options and let you know which one I think is the best structure for particular types of investments. Let's start with holding investments in your own name because this is the most simple of all the options you have. This is where you simply purchase the investment and just use your own name. You don't need to set up any other type of structure. You'll then be taxed in your own individual tax return. You'll then pay tax at your marginal tax rate. So depending on where your total income falls will depend on what rate of tax you're paying on that particular income. Now, when you're working out your income, you have two different types of income. You either have ordinary income, which is taxed at the time you receive it. And this is going to be on your income generating assets. This will be things like dividends on shares or rental income on your investment property. Then you potentially could have capital gains events, and this takes place when you sell your investment. Your capital gain at a basic level will be sale less the cost of that asset. Now, with capital gains, you potentially can receive a discount if you've held them over 12 months. So you receive a 50% discount, and you're eligible for this as an individual investor. So in summary, holding it in your own name is a very simple option, is a low cost option, and it does still give you the capital gains discounts. However, it is obviously the least flexible because all income will be directed back to yourself. This leads well into the second option, which is joint names, which is very similar to holding them in your own name. However, instead of being in one person's name, we now have two or more names. So the most common situation here might be spouses where they might own investments 50-50. Maybe they've gone out and purchased a property or they've gone and bought some shares and they put them in joint names. So we're still going to be taxed very similarly to the put in your own name, but instead you're only going to be taxed on your share. So if it is 50-50 and you receive a dividend, then 50% of that dividend gets included in your name and then 50% gets included in your partner's name. Now, capital gains will still flow through at those same percentages, and then discounts and losses are applied at an individual level, not at a joint level. So that is something to keep in mind if you're holding joint investments when you go to sell them. Again, this is relatively low cost. In some situations, you might need some kind of agreement put in place where you might have to pay for some legal advice, but in general, a lot of investments that are held like this don't really incur any additional costs compared to putting them in their own names. Now, if you're wanting that particular individual advice for your situation, my business, Rooshock Accounting, does a lot of this work. I love doing structuring work with clients to work out what's going to be best for them in the short term and long term. So if you'd like to get in touch about that, feel free to reach out to us via our website. Now let's talk about trusts. And when I'm talking about trusts, I'm going to be typically talking about discretionary family trusts. So trust is a little bit complex on what actually happens behind the scene. But in essence, they are a structure where the trustee holds assets on behalf of the trust, and the trust therefore makes distributions to its beneficiaries, and they're taxed then at a beneficiary level. So what happens, the trust will make income, the trustee will make a resolution on how that income is to be split, and because it is a discretionary trust, the trustee has the discretion to split that how it best sees fit. So this split can be different from year to year. So you might have a 50-50 split in year one, and maybe in year two it's 75-25. So you can straight away see that the trust is giving us way more flexibility when compared to the previous options we've talked about. Now, some trusts even allow for splitting of particular income classes. So you might be able to split dividends 50-50, but for capital gains, maybe one of the people that are entitled to potentially receive a distribution has a capital loss in their own name. Therefore, you might want to distribute 100% of the capital gains to that person. So again, we're seeing more layers of complexity, which obviously opens up more options for us when we're doing some type of tax planning. Trusts can still distribute capital gains that then allow a capital gains discount to be applied at an individual level. And that's the thing to remember with trusts, is a trust will typically distribute out all the income, and then the beneficiaries will pay tax at their own marginal tax rate. So this is obviously a great way to balance up incomes. Maybe you've got a partner who isn't working at all. Maybe they've had kids and taken some time off to look after the children, and therefore they've got no other taxable income. They're receiving no other Centrelink benefits, for instance, and therefore they're on a 0% marginal tax rate versus maybe someone that's working full-time and could be on the highest 47% tax rate. So you can see there can be dramatic tax savings when you're using a trust structure. Now, if you are using a trust to buy property, just be aware there could be some land tax implications that may negate all the other tax benefits. So make sure you do some research in that area. A trust does have a startup cost though, so you're gonna have to pay to get your trust set up. You potentially have got ongoing ASIC fees if you've got a trustee company. You've also potentially got additional accounting fees because you're now having to lodge a trust tax return and potentially keep trust financial statements. And you could even have additional legal fees if you're needing to make adjustments to your trust further down the line. And then the fourth option is holding your investments in a company. So a company pays a flat rate of tax on its investment income. Now, if you've just got investments, it will typically be 30% flat rate. However, the company tax isn't really the final tax paid on it, because eventually the company will distribute income out to its shareholders, which will then pay tax at their marginal tax rates. This gives us flexibility to give out dividends in years that suit us best. There can be some great strategies around holding capital assets, selling them, and then distributing dividends out to the shareholders in retirement, and you could even potentially pay 0% tax. Because of the flat tax rate of 30% in a company, it can be a great way to build wealth, especially if you're on highest marginal tax rates. Especially if you're selling assets on a regular basis, or you've got income generating assets, you might only want to pay the 30% tax rate on these rather than having them taxed in your personal names, and you want to compound that income, you want to compound that growth, and a company could be a great avenue for this. The downside with a company though is you don't receive a capital gains discount. So you need to keep that in mind if you've got capital assets within a company. If you sell them, you're not going to get that 50% discount if you hold for over 12 months. So for instance, if you have a $1,000 gain in the company, the tax is going to be $300 at that flat 30% tax rate. Now this is in comparison to if we had that $1,000 gain that had been held for over 12 months in any of the other options we've talked about, they would potentially get that 50% capital gains discount, so it'd only be taxed at $500. And if we assume the average marginal tax rate of 34.5 cents, then we'd only be paying $172.50 tax on that. So that is something to consider if you're potentially thinking about using a company structure. A company also comes with ASIC fees on an ongoing basis, and you might have additional accounting fees, plus obviously those setup costs. A company could also though give you some legal protection and some asset protection. Go and speak to a lawyer about this. So what is the best structure? Well, it's going to depend on your own situation, your own income levels, who you've got available to distribute to, plus what your goals are short and long term. So it's something you really want to make sure when you're setting up any type of structure, you're not just thinking about the short-term benefits, but also the longer-term benefits. So if you do have lots of people to distribute to, maybe you've, like I said, got a spouse that isn't working, or maybe you've got some children you'd like to help out and they're not currently working, then a trust could be a great option for you. This is because we can distribute that income where we best see fit and potentially give that income to people on a lower marginal tax rate. The savings could be up to 47% here if we're talking about someone on the top marginal tax bracket versus someone with no other taxable income. Now, if you're considering purchasing a property, a lot of the time people avoid using trusts in companies due to some of the land tax implications or the capital gains discount not being there for companies. So a lot of people do hold these in personal names, but there are particular situations where you might want them in a trust or a company. Now, a company could be great for those income generating assets in particular, where you want to cap that tax at the 30% on an ongoing basis so you can compound that. A company can also be great for some really long-term strategies where you sell capital assets, you're not getting the capital gains discount, but you're planning on distributing this out to individuals in a long-term situation, maybe once they're retired. Go and seek advice on that particular situation. A trust is going to give you more flexibility and never be worse off tax-wise than holding it in your own names or in joint names. However, you need to make sure that any benefits are outweighing the costs of those entities. And that's why you want to make sure you understand why you're setting up the entity, especially if someone else has advised you. Do you understand what the real benefits in the short term and the long term are for you? If you do want to know more about trusts and companies, in this upcoming video, I actually talk about family trusts versus companies in even more depth. I'd love for you to go and check it out, and I appreciate you watching this one.